Now let's go back to this 5Cs framework of pricing strategy. We've talked about company objectives and customers. Now let's get to know more about cost. To make effective pricing decisions, firms must understand their cost structure so they can determine the degree to which their products or services will be profitable at different prices. Although companies incur many different types of costs as a natural part of doing business, there are two primary cost categories: variable cost and fixed cost. Variable costs are those costs that vary with production volume, such as labor and material costs. As a firm produces more or less of a good or service, the total variable cost increase or decrease at the same time. So the formula for total variable cost equals to variable cost per unit and multiplied by quantities. Because each unit of the product produced incurs the same cost, marketers generally express variable cost on a per unit basis. So let's think about a bakery. So the majority of the variable costs are the cost of ingredients, for example, flour, and also the cost of like electricity. Though not always the case, variable cost per unit may go up or down with significant changes in volume. So for example, if the bakery makes 1,000 loaves of bread in a month, it would have to pay a higher price for ingredients on a per pound basis than if it were producing 1,000,000 loaves, because the more ingredients it purchased in a big bulk, the less expensive those ingredients become. The second category of cost is called fixed cost. Fixed costs are those costs that remain essentially at the same level regardless of any changes in the volume of production. Typically, these costs include items such as rent, utility, insurance, administrative salaries, and the depreciation of the physical plant and equipment. For example, whether the bakery makes 1,000 loaves or 1,000,000 loaves of bread, the rent it pays to the landlord remains unchanged each month. Total cost is simply the sum of the total variable cost and fixed cost. Next, we'll illustrate how to use these costs in simple analysis that can inform managerial decision-making about setting prices. So let's have a little review of what we learned in Chapter 9 when we talk about STP. We use this example to make decisions on which segment homeowners or business is more profitable for the new started loan company to choose. And in that example, we have a variable called average variable cost, which is basically labor. So for homeowners, it's $40 for each time, but for businesses, like services, it costs $100 on labor. The other variable that we have is fixed cost. The costs related to equipment, advertisement, utility, rent, and insurance, and etc. So as you can see here, for if the loan service company choose the business segments, of course they need to buy bigger equipment or more equipment, and the utilities will be more, and the place for storage those equipments would be like more, and also the related insurance would be more. So the fixed cost for serving the business segment is $1 million, which is much higher than the fixed cost of serving the homeowners segment, which is $400,000. So let's learn how to do the break-even analysis. A useful technique that enables managers to examine the relationship among cost, price, revenue, and profit over different levels of production and sales is called break-even analysis. Central to this analysis is the determination of break-even point, or the point at which the number of units sold generate just enough revenue to equal to the total cost. At this point, profit is zero. Although profit, which represents the difference between the total cost and the total revenue, can indicate how much money the firm is making or losing at a single period of time, it cannot tell managers how many units a firm must produce and sell before it stops losing money and at least break even, which is what the break even point does. So let's look at this example together. Suppose that a particular hotel calculates its total revenue cost to be $10 per room and per night. That's the variable cost. And each room is priced at $50 per night. The fixed cost of the hotel is hypothesized as $100,000 each year. From these slides, the graph contains three curves. We have the total cost curve, and we have the fixed cost curve, and then we have total revenue curve. The vertical axis of this graph measures the revenue and cost in dollars, and the horizontal axis measures the quantities of units sold. The fixed cost curve will always appear as a horizontal line straight across the graph. The fixed cost curve will always appear as a horizontal line straight across this graph, as you can see, because fixed costs do not change over different levels of volume. The total cost curve starts where the fixed cost curve intersects the vertical axis at 100,000 when volume is equal to 0. That means at that time no units is sold. The fixed cost of operating the hotel remains and cannot be avoided. Thus, the lowest point of the total cost can even reach is equal to the total fixed cost, that is 100,000. Beyond that point, the total cost curve increases by the amount of variable cost for each additional unit. Finally, the total revenue curve increases by the price of each additional unit sold. So from this slides, you can see three different colored sections. The orange section, that means the fixed cost, and the red area, that means the losing money area. Among this area, your total revenue is less than the total cost. And the green part area, that means the total revenue that you gained is more than the total cost that you spend. In this area, you see profits, which is representing by the green area. And the point, these two lines, which is total revenue and total cost, intersect. That point we call break-even point. To calculate total revenue, we multiply the price per unit by the number of units sold. The formula for these calculations are shown in this slide. If we study the graph carefully, we find that the break-even point is 2,500, which means that the hotel must rent out 2,500 rooms each year before its revenue equals its cost. If it rents fewer than 2,500 rooms, it loses money, which is the red area. If it rents out more of the rooms, it makes a profit, which is the green area. To determine the break-even point in units mathematically, we must introduce one more variable, which is the contribution per unit. And the contribution per unit just represents the difference between the price and the variable cost per unit. So it can be calculated by deducting $10, which is the variable cost of each room per night, from the $50, which is the setup price for each room per night. And then we can use the formulas to find out the break-even point, which is the total fixed cost, 100,000, divided by contribution per unit, which is $40 per room per night, and the break-even point is 2,500 rooms nights. So again, let's look at the formulas for total variable cost, total revenue, and then do the calculation. Break-even is not a bad thing, but hardly a satisfactory outcome for most business, because businesses are set up to make profits. A manager may be more interested in learning the necessary sales level to achieve or targeted profits. Remember, at the beginning of this chapter, we talked about the company objectives, and one of the objectives is profit-oriented. So if a company tries to achieve a targeted profit, and they can add this targeted profit and calculate back to the necessary unit of products that they need to sell. The approach is to solve this problem is to treat the target income like an added increment of fixed cost. In other words, the margin must cover the fixed cost and the desired profit. Let's extend the simple break-even analysis to show how many units a firm must produce and sell to achieve a target profit. Still in this example, if the hotel wants to make 200,000 profit each year, how many rooms would it have to rent out at the current price, that is $50 per room per night? So using the formula at the top, we find the new break-even point is 7,500 rooms. And how to do that? So we first add the target profit, which is 200,000 per year, to the fixed cost, and then divide it by the contribution per unit. Then we get the new number of rooms nights. That means if this hotel wants to achieve the goal of making a target profit of 200,000 per year, it needs to rent out 7,500 rooms nights at least. If it rents out more, it will earn more than 200,000 per year. But if it rent out less than this number of rooms nights, that means it cannot achieve the target profits of 200,000 goals. A break-even analysis help managers assess their pricing strategies because it clarifies the conditions in which different prices may make a product or service profitable. It is a very powerful tool when performed on a range of possible prices for comparative purposes. However, I want to point out the limitations of break-even analysis. First, it is unlikely that a hotel has one specific price that it charges for each and every room. You know that for hotels it has different rooms and different rooms have different rates. So the price it used in the break-even analysis is probably just the average price. So it's a approximation there. And second, break-even analysis does not take into accounts of like economy of scale. As we know that if a group or an organization wants to rent out rooms, hotel rooms, many hotel rooms at several nights, usually they get discounts. So price often get reduced as the quantity increased because the cost decrease. So firms must perform several break-even analyses at different quantities. The last one is a break-even analysis cannot do demand forecasting. In break-even analysis, we try to find the numbers for revenue, cost, and profitability at a set price, and we just assume the demand there. But we really don't know the seasonalities of the demand and also the changes in customers' preferences. So in this case, break-even analysis cannot help us do demand forecasting.